Or renegotiate. Like if you have a credit card, don't just assume whatever they're charging you is what you have to pay. Call and renegotiate. Ask questions like, hey, what are your best deals? Are there balance transfer deals? If I'm looking to cancel, what can you do for me to keep me as a customer? These types of questions so you get to the retention department and they lower those interest rates. Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions.
Garrett Gunderson, Ask the Money Nerds. We're talking credit cards today.
Credit card debt. The thing that people get pissed off about. Sometimes it's fun to get into, not always fun to get out of, and sometimes it's circumstantial, just crazy things that happen that put people in this situation. So this is judgment-free zone. It's more about how do we create some solutions here. We've got a few questions that came in. I'll turn it over to Chief of Staff Stolba.
Yeah, let's dive in.
Amanda Stolba.
Yes, let's give the people what they're looking for. Okay.
Give the people what they want.
Yes. We're here to answer all of your money questions. So the first one's coming in from Romina. She says, my question is, how do we pay off our credit card debt? We owe $20,000 in balances. I was thinking of applying for a fixed personal term loan, which we are approved for at 11.9% for 84 months. I'm on Social Security disability of $2,300 a month. My hubby averages $15,000 adjusted gross income per year. We just can't get out from underneath the credit cards. I want to be in somewhat of a financially secure place in 3 years. I know we can do it. We just need some guidance. So let's give Romina and her husband some guidance on what to do with their credit card debt.
You said that the reason he's at $15,000 of income per year is some health issues.
Yeah, there was just a series of unfortunate events that happened that kind of put him in a tough spot.
That's the first thing I look at in this situation is how do we increase income, right? If that's at all possible. Is there, side hustles? I did a phone call this morning. You heard me on speaker. They're making money on their vehicle using Turo.com. They're driving it. They're renting it out 3 times a month, and that renting it out on Turo is paying for the car and cash flowing. So you can always look at existing resources to find out how to be resourceful. One of our mutual friends that's been on the podcast a bunch and YouTube with me, Demi, rented out a room on Airbnb. There's millions of stories of Uber and Lyft drivers like that. Like you always got to look at do you have existing resources and things that you can do to be more productive. I started my first car detailing business because my dad had plenty of cleaning supplies in the garage. My mom worked at a credit union. My dad worked at a coal mine, and I cleaned those vehicles. So look at what you have there first. Then we look at the loans. And to me, one of the things that's critically important is called cash flow index, where we take the loan balance, we divide it by the monthly payment. Okay. If this number is 50 or less, we have a cash hog on our hands, right? That means it's a very inefficient loan. If that number is, greater than 100, that's a really efficient loan. It's actually not requiring a very large payment for how much money you've borrowed. So if you're trying to pay something off, you want to know your cash flow index of any loan that you have because it kind of tells us the priority. Now, in their situation, the 11.9% is high, but at the same time, because she's on fixed Social Security amount of income and her husband's not earning as much income, that's why it's a higher interest rate. Now, did they have other assets or anything else?
She didn't go into details on that.
One of the things I always look for is there other assets that are out there? Could you borrow from a 401k? Could you borrow from cash value? Could you go refinance a car? Right? We're looking for anytime you have collateral, like cash value has collateral of life insurance where they'll lend you money based upon how much you have. Usually loan interest rates on 401ks are really low. Now, it's not my favorite place to go borrow money because there's fixed payback periods and it's all pre-tax dollars that you're paying back with after-tax dollars. So there's disadvantages, but if we can lower the interest rate, we can lower the payment, we can improve the cash flow. Those are things to look at. There's also intra-family loans. We've had people that just borrow from family members because they're sitting on plenty of cash. We've done it for down payments for mortgages and things like that because now they're earning more than they were in their measly savings account. But at the same time, there's collateral behind it, and they're helping out someone they care about. So I want people to think more resourcefully first. And so 11.9% for 84 months, that's kind of a high payment. Obviously, that's going to be a lot of their income, is going to go to this. So I want to look at those other options.
Now, if she has the option of refinancing a current car loan that her and her husband already have, how would one go about doing that?
Go to your bank or credit union. It's already collateralized. So it's a refinance. Most people don't think about, they think about buying a car and financing it up front. But if it's paid off, you could always go and get a loan. The car is collateral. It's actually a car loan. So
Yeah.
you're going to go talk to wherever you're currently banking at, where you already have an account.
Okay. Now, the other thing I think is really important is understanding the cost of money.
Mm-hmm.
Will you go into that a little bit?
Okay, cost of money is simply the highest interest rate that we're paying for our money is the cost of money. So in her case, 11.9%. If that's where all of her loans, that anytime she spends $1, it's costing her 11.9%, right? So it's the highest amount that we're paying on our money. Or it's forfeiting interest that we earn, depending on what that is. So let's say I know I can earn 5% on my money. I know with really high levels of certainty, 5% is pretty easy to do. Anytime I spend $1, I'm forfeiting the right to earn 5% interest. So it's either, we always have an interest cost, right? We either pay interest if we borrow, or we forfeit the right to earn interest. Either way, there's an interest cost. It's just more obvious the one that we're paying for than when we forfeit the right to earn. So our cost of money is kind of that bar that says, at this point, I have to earn at least this much to make it worth my time. Like if you have a 5% loan and someone comes and says, I can get you 3% guaranteed, not too exciting because you're losing, right? Because you're paying 5 and you're only earning 3. On the other hand, if you're only paying 3 and you can earn 5, maybe the fastest way to pay off that loan is earn the 5% if it's got predictability, if it's stable, if it's secure. There's a lot of people that erroneously, like remember your college notes that said, oh, the market's just going to do 12%. Well, if the market was really going to do 12%, the slowest way to pay off a mortgage would be pay the bank extra money. The fastest way would you invest the 12%, and then when it grows, you pay the mortgage off, and you've earned more than you would have saved by paying it down, right? But the reality is the market doesn't get 12%. It doesn't do that long term.
Yeah.
There's a whole bunch of fees and taxes and all sorts of riddled with holes along the way where it goes down. So we have to be really careful. But knowing our cost of money helps us understand whether we should invest or pay off, whether something's efficient or inefficient, effective or ineffective. So I always think about my cost of money before I do something because there's always an interest cost.
And that's where the cash flow index comes in, is understanding your cost of money.
So knowing your cost of money, it's personal finance has to be personal. For some people, paying off a loan is so critical for them because it brings peace of mind. They feel, oh, I'm finally free. For other people, like I have a mortgage on my home. I don't have car loans. I don't have a mortgage on my cabin, but I have it on my home because I don't plan on staying there forever. It's really low interest, and in a highly predictable way, I can out-earn it. And I could pay the home off tomorrow if I want to pull it out of my cash values. Now, other people, they just don't feel comfortable with that. They're going to lose sleep. No savings is worth that, right? So maybe you're just best paying that off, and now you can be more productive. One is the economics, which is your cost of money. The other is your peace of mind, which is just what your personal preference is. And I think we need to take both things into consideration, where some financial gurus just automatically go, pay off your debt or else you're enslaved. The Bible says pay off your debt or else you're enslaved, but most people haven't even identified what debt is. Debt's when you owe more to someone than you have in an asset. When you have an asset worth more than what you owe, that's actually equity. It's the opposite. So my home is worth more than the loan on it. I'm not in debt. I'm in equity, but I do have a mortgage. Now that's probably blowing a few people's mind. A few people are pissed off right now and they want to tell me, paying off my mortgage is the best thing I've ever done in my life. I'm not.
Some people get very passionate about that.
If you paid it off, congratulations.
Yes.
I never told you not to. I have no dog in the fight. I don't care. It's just know your options and do what's best for you.
And the peace of mind is a really important factor. I think sometimes gets left out of the equation. It's just like if you scrimp and you save and you kind of cut back, like eventually you'll get there and be able to enjoy your life and you'll be able to show up. But I think peace of mind allows us, like if we consider that in part of this situation and in our lives, it allows us to show up differently in the world. And when we show up with more confidence, because we have peace of mind, then we can create greater value. We can be more creative with our thoughts. We're more open to connecting to other people, which expands our means. So peace of mind is actually, I think, a really important part of deciding what to do with our money.
It's an essential piece.
Yes. Okay, so we're going to move on to a question coming in from Richard. Okay. So you've discussed a couple of ways that Romina could pay off her loans. Richard has a specific question. He said, should I follow Dave Ramsey's plan or use a different strategy for paying off my debt faster? I've been doing some research on trying to pay off my debt. I love the idea of the snowball effect where I pay off the lowest bill first and use the extra income to pay towards the next biggest loan. Do you have any suggestions or comments? I'll let you speak, and then I have a couple of follow-up questions.
You know, that's a good plan. What I like to do is a combination of what's called the cash flow index that we just showed, loan balance divided by monthly payment, and you only attack one loan at a time, pay the minimum to everything else, and it's the one with the lowest. The lowest cash flow index is what you're going to pay the extra to. Now, the difference between that and debt snowball is this takes a little bit of consideration into the interest rate.
Yeah.
Right?
Mm-hmm.
I mean, I like the philosophy of let's just pay off the one that's the easiest to pay off, the fastest to pay off, because then that's freed up and we got more cash flow. Love that. But this is just going to be an equation that says, well, let's figure out which one's going to be the bigger movement.
Which one should I tackle first?
Right?
Yep.
And then in order to really improve it, the 3 R's are restructure, reallocate, and renegotiate. So to restructure a loan, we're looking at, well, what if you refinance your home and pull other loans into it that have higher interest rates and now you got lower interest rate? What if you know, what we said earlier, refinance your car and pay off higher interest rate loan? So if you can restructure or refinance loans, you might be able to get better cash flow indexes and therefore pay less in interest. Then the second thing is reallocate. Let's say that you just have an underperforming asset. You have something that's not earning a high interest rate, but you're paying more than what it's earning. Let's cash that thing out, pay off that loan, and then that's going to free up that cash flow. That's going to get you a guaranteed return because you've saved the interest. Or renegotiate. Like if you have a credit card, don't just assume whatever they're charging you is what you have to pay. Call and renegotiate. Ask questions like, hey, what are your best deals? Are there balance transfer deals? If I'm looking to cancel, what can you do for me to keep me as a customer? These types of questions, so you get to the retention department and they lower those interest rates. Or a streamlined refinance with your home where you stay with the same company but get a lower interest rate because you have options because interest rates are low. You just have to make sure you have a good credit score, decent collateral, which is cars and homes are decent collateral, right? The right cash flow reporting, so you look good to the bank.
Yeah.
And then good connections, so you're going to the right institutions that specifically deal with what you're looking for. So I would say go with the cash flow index, pay only extra to one loan at a time. But as you do that, look to restructure, look to reallocate, and look to renegotiate the interest rate so that you can actually get ahead even faster.
Okay. So is there ever a time when the snowball method is a good fit for reducing debt?
Sure. It's not a bad method at all. Yeah.
Just always
Helped out a lot of
consider
people.
the cash flow index,
Yeah.
the interest rate.
I'm just giving a little bit different take on it. And here's my big concern. If you're trying to eliminate debt, don't get in a scarcity mindset that's all about reduction and sacrifice and scrimping and saving. Look to keep more of what you make, get more efficient. Look to expand your means, like you said. How can you add more value? How can you increase your income so you have more to work with?
Yeah. Amen to that. I remember when I was using the snowball method myself to pay off my Plymouth Neon back in college. and just even after I graduated, my Plymouth Neon, it was purple, just riding in style.
Is Plymouth in business these days? I haven't heard that word for a while as a car company.
I mean, I don't know. I don't keep up on cars.
Okay, yeah.
But maybe it was a Dodge. Who knows? But anyway.
I think it was a Dodge Neon.
Okay. So I was paying off this little car of mine. But I remember spending hours every month.
That's the concern.
Like budgeting. And I would erase and I would move money around.
Did you feel inspired?
I would fill my envelopes and it was not inspiring. I wasn't thinking about how to expand my means. It was just me trying to get by.
You've got to start with production first.
Yes.
And reduction second.
Yeah.
Be mindful with your cash. Frugal's fine, but as soon as that starts to turn into miserly, as soon as that starts to consume your thinking, as soon as that starts to be, you miss out on life and you don't invest in yourself and you don't think about impacting others or value creation, that's where it becomes detrimental.
And it was actually really stressful for me, so
Now I'm just stressful for you. That's what you traded off. You don't have to worry about your debt, but you got to stress about my crap.
Yeah. So I think it's a good starting point. Like you said, Richard, maybe just incorporate some of these other things. And, if I think of investments, if I would have spent the 2 hours a month investing in myself, investing in ways to expand my mind and, grow in deeper ways, I probably would have been more fruitful. So I know that's preaching in the choir. You talk about that all the time, but I experienced that. Right. So I can relate to Richard, and I think it's a great question. So Romina, Richard, we understand credit card debt can be very stressful. And I think it's something that a lot of people deal with. I think there's some stats about how people are just a paycheck or two away from being in a really difficult spot. And so it's easy to reach for credit cards. And so I think these questions, while 2 of them came in from different individuals, it's a really common thing to wonder what to do with credit card debt. So I think we've given some people some good things to think about.
All right.